September 1931, Britain abandons the gold standard overnight. Sunday announcement. Monday morning, the pound crashes 25%. By month's end, down 40%. Two groups of people experienced completely different outcomes. Those holding pound-denominated bonds and savings accounts watched decades of wealth evaporate in weeks. Those holding gold, productive farmland, and foreign assets saw their purchasing power protected and, in many cases, dramatically increased. The wealth didn't disappear. It transferred. From those who trusted paper promises to those who understood what holds value when a currency loses its anchor. The mechanism was invisible to most. By the time they recognized the pattern, the transfer was complete. This isn't about predicting crashes. This is about understanding which assets preserve purchasing power when a reserve currency gets bypassed rather than replaced. Because the answer isn't what most people think. By the end of this video, you'll understand the four-category framework that determines what survives versus what collapses during monetary transitions. You'll see why certain assets preserved wealth through Britain's 1931 crisis, through Bretton Woods in 1971, and through the euro launch in 1999. You'll learn why the transition destroys fixed income first, then spreads to currency holders while rewarding those positioned in real assets. And you'll understand the mechanism of wealth transfer that operates silently during these transitions. This isn't financial advice. This is historical pattern analysis. Because when a system transitions, the outcomes are remarkably consistent across centuries and continents. The assets that survive aren't random. They follow mathematical logic based on what retains value independent of government promises. When a reserve currency loses its exclusive privilege through bypass rather than crash, assets sort into four categories based on a single criterion: dependence on government promises versus intrinsic utility. Category 1, government promises. These are financial instruments whose value depends entirely on a government's ability and willingness to honor obligations. Government bonds, treasury securities, fixed-rate pensions, cash savings, annuities. When the currency loses privilege, these assets face the highest risk because they're denominated in a weakening unit of account. A bond promising $1,000 in 10 years is only valuable if those dollars retain purchasing power. If they don't, the promise becomes worthless, even if technically honored. Category 2, leveraged paper claims. Real estate mortgages, corporate bonds, structured products, derivatives. These occupy middle ground. They're denominated in currency but backed by real assets. During transitions, outcomes depend on whether the underlying collateral retains value faster than the currency loses it. Real estate secured by productive land often survives. Paper claims backed by nothing tangible typically don't. Category 3, portable real assets. Gold, silver, precious metals. Commodities that can be physically moved and stored. These assets hold value because of intrinsic utility and scarcity. Gold has been money for 5,000 years, not because governments decree it, but because it can't be printed, it doesn't corrode, and it's universally recognized. During currency transitions, portable real assets typically surge in price relative to the weakening currency, not because they become more valuable, but because the measuring stick shrinks. Category 4, productive real assets. Farmland that produces food, businesses that generate cash flow, infrastructure that provides essential services, energy resources with ongoing demand. These represent the ultimate survival category because they produce value regardless of what happens to any currency. A farm producing wheat is valuable whether you measure it in dollars, euros, yuan, or seashells. The productive capacity doesn't change even when the monetary system does. The pattern across history shows wealth flowing from Category 1 and 2 toward Category 3 and 4 during transitions. Not because of conspiracy, not because of manipulation, because of mathematics. When currency loses credibility, capital seeks safety in assets whose value doesn't depend on that currency remaining stable. Let's examine 3 transitions where this pattern played out with documented precision. Britain, 1931. The context matters. Britain had returned to the gold standard in 1925 at the pre-war parity, which overvalued the pound and made British exports uncompetitive. By 1931, maintaining the peg required deflation that pushed unemployment above 20%. The political pressure became unbearable. September 21, 1931, Britain suspends gold convertibility. The pound immediately drops from $4.86 to $3.40. Within 6 months, down another 15%. British government bonds, called gilts, held primarily by domestic savers and pension funds, lost 30% of purchasing power in sterling terms and over 40% in gold terms. Here's who survived and who didn't. British savers holding gilts, the safest investment in the empire for 2 centuries, were destroyed. A pension promising $1,000 per year could still buy only $600 worth of goods by 1932. The promise was kept nominally, but the value collapsed. British investors who had moved wealth into gold before the crisis saw their holdings increase from 4.25 per ounce to 7.32 per ounce in sterling terms, a 72% gain. Not because gold became more valuable, but because the pound became less so. Those who owned productive farmland in Britain saw land values hold relatively stable in real terms, while currency-denominated savings collapsed. Food production remained essential regardless of monetary chaos. British investors with assets in America, particularly those who had purchased U.S. real estate or held dollar-denominated securities, saw substantial gains. The dollar strengthened against the pound, and American assets held their value, while British currency depreciated. This is geographic diversification proving its value during monetary stress. The wealth transfer was massive and permanent. The British middle class, which had dutifully saved in gilts and pound-denominated accounts, lost decades of accumulated wealth. Those who understood the pattern and repositioned into real assets or foreign holdings preserved and even grew their purchasing power. The lesson was clear. Government promises denominated in a weakening currency are not safe regardless of how secure they appear. August 1971, Bretton Woods collapses. President Nixon closes the gold window, ending dollar convertibility. The dollar immediately loses 8% against major currencies. Over the next decade, it loses 50% in purchasing power. Here's what happened to different asset categories. U.S. Treasury bonds, considered the safest investment on earth, generated negative real returns throughout the 1970s. Investors holding 30-year treasuries purchased in 1970 lost 40% of purchasing power by 1980, even with interest payments reinvested. The government honored every promise, paid every coupon, returned every principal. But the dollars returned bought far less than the dollars invested. Gold, which had been fixed at $35 per ounce, surged to $200 by 1974 and peaked at $850 by 1980. An investment in gold in 1971 multiplied 24 times by the peak. This wasn't speculation or bubble dynamics. This was capital fleeing paper promises and seeking assets that couldn't be debased. Productive farmland in the United States increased in value from an average of $196 per acre in 1970 to $730 per acre by 1980. A 276% increase. Food production remained essential. Land remained finite. Currency depreciation made tangible assets more expensive in nominal terms while preserving real purchasing power. Companies with pricing power, particularly energy producers and commodity-linked businesses, saw stock prices rise substantially during the decade, despite overall market weakness. Their ability to raise prices as currency depreciated protected shareholders. Meanwhile, banks and financial institutions holding fixed-rate mortgages and bonds suffered as inflation destroyed the real value of their assets. The pattern repeated with precision. Category 1 assets, government promises, and fixed-income securities were devastated. Category 3 and 4 assets, gold and productive real assets, preserved wealth and generated substantial gains. The transfer happened systematically over a decade. Those who recognized the pattern early positioned correctly. Those who trusted that this time is different paid the price. Eurolaunch 1999. This transition was different in that it was planned and peaceful, but the asset dynamics followed similar patterns. Germany, France, and other core European nations abandoned their national currencies for a shared monetary unit. German citizens holding Deutschmark-denominated bonds faced a choice: convert to euros or exit the system. Most converted because there was no alternative for domestic savings. But those who had diversified internationally, particularly into Swiss francs or assets outside the Eurozone, maintained optionality that proved valuable during subsequent Eurozone crises. The euro initially strengthened, then weakened substantially through the 2000s, losing 30% against the dollar by 2002. Real estate in core European cities held value. Productive businesses adapted. But fixed-income securities denominated in the new currency faced persistent pressure as the European Central Bank pursued increasingly aggressive monetary expansion. The lesson from 1999 wasn't about crisis, but about transition. When monetary systems change, having exposure to assets outside that system provides protection. Germans who held only euro-denominated assets were locked into the new system's fate. Those with geographic and asset diversification maintained flexibility. 3 examples spanning 7 decades, same pattern. Assets dependent on government promises and currency stability suffered. Assets with intrinsic value or productive capacity preserved purchasing power. The mechanism is mathematical, not mystical. So what signals show this pattern activating today? Where is capital actually moving in anticipation of dollar bypass dynamics? Central bank gold accumulation reached 1,136 metric tons in 2022, 137 tons in 2023, and is on pace for similar volumes in 2024. This represents the highest sustained purchase rate in over 50 years. China, Russia, India, Turkey, Poland, Singapore, all adding gold to reserves while reducing dollar holdings. This isn't ceremonial. This is Category 1 to Category 3 reallocation at the sovereign level. Central banks are explicitly reducing exposure to dollar-denominated assets and increasing holdings of assets that can't be printed or sanctioned. When the largest, most conservative institutions on Earth systematically rotate away from government paper into tangible assets, that's not a signal. That's a siren. Farmland prices in the United States have increased 40% since 2020. This exceeds inflation, exceeds wage growth, exceeds almost every traditional investment. Why? Because institutional capital recognizes that productive land represents Category 4 assets at a time when Category 1 and 2 face increasing risk. Bill Gates owns approximately 270,000 acres of U.S. farmland, making him the largest private farmland owner in America. This isn't about farming. This is about owning productive real assets that generate essential commodities regardless of monetary system stability. BlackRock and other institutional investors have launched agricultural investment vehicles targeting farmland acquisition. Chinese entities have attempted large-scale farmland purchases near strategic U.S. infrastructure. The competition for Category 4 assets is intensifying because sophisticated capital understands what happens during transitions. Food production remains valuable whether measured in dollars, yuan, or gold. Ownership of that production capacity provides protection that paper promises cannot. Commodity performance relative to financial assets shows the rotation clearly. The Bloomberg Commodity Index, which tracks energy, metals, and agricultural goods, has outperformed the S&P 500 on a risk-adjusted basis over the past 4 years. This isn't normal. Typically, financial assets outperform commodities during stable monetary periods because they offer leverage and compounding returns. The reversal indicates capital is prioritizing safety in tangible assets over returns in paper claims. Industrial metals, particularly copper and aluminum essential for infrastructure and electrification, are trading at prices that reflect long-term scarcity concerns rather than short-term demand cycles. Silver, which serves both monetary and industrial purposes, has shown persistent strength despite economic uncertainty. Real asset rotation extends beyond commodities to physical infrastructure. Private equity firms are aggressively bidding for water rights, energy distribution networks, logistics infrastructure, and telecommunication systems. These assets generate essential services that must be consumed regardless of currency valuations. Ownership provides pricing power that protects against monetary depreciation. Meanwhile, Category 1 assets show stress. U.S. Treasury auctions have experienced declining foreign participation, dropping from 30% to 24% over 18 months. Bid-to-cover ratios, which measure demand relative to supply, have weakened from 2.47 to 2.31 for 10-year notes. These are technical indicators that only bond traders watch closely, but they reveal that foreign holders are reducing exposure systematically. The gap is being filled by the Federal Reserve itself, which expanded its balance sheet to compensate for reduced foreign demand. This is circular financing. The government issues debt, the central bank buys it with created money. This works until it doesn't, when it stops working when foreign holders recognize the debasement and accelerate their exit. Fixed income funds have experienced sustained outflows while commodity-focused ETFs and real asset funds see record inflows. Retail investors, often the last to recognize transitions, are beginning to sense that traditional, safe investments carry more risk than advertised. This is late-cycle behavior that typically accelerates as the pattern becomes undeniable. Here's a signal most people miss. The yield curve, specifically the difference between short-term and long-term interest rates, has been inverted or flat for extended periods. This indicates bond markets don't trust that currency will hold value over long time frames. Investors demand higher yields for short-term exposure than long-term, which is backwards from normal conditions. It signals expectations of currency instability and policy constraints. Real estate markets show bifurcation. Luxury properties in major cities face pressure, but productive agricultural land, industrial facilities, and energy infrastructure see bidding wars. This is capital distinguishing between Category 2 assets backed by nothing and Category 4 assets with productive utility. Mortgaged residential real estate in overvalued markets represents leveraged exposure to currency risk. Productive farmland represents real asset ownership. The pattern is consistent across asset classes and geographies. Capital is flowing toward assets with intrinsic value and away from promises whose value depends on currency stability. This is happening quietly, systematically, without headlines or drama. By the time it becomes obvious to the general public, the positioning will be complete and the transfer largely finished. So what actually happens to wealth during these transitions? Who loses and who survives? The mechanism is straightforward but devastating for those unprepared. Fixed income investments, including government bonds and cash savings, lose purchasing power even if nominal values remain stable. A bond promising $10,000 in 10 years will likely pay $10,000 as promised. But those dollars will buy far less than $10,000 buys today. This is the invisible tax of currency debasement. Your account balance? Same number. Your purchasing power? Silently evaporating. A retiree living on fixed pension income discovers their $3,000 monthly payment buys what $2,000 bought 3 years ago, then what $2,500 bought 3 years after that. The promise is kept, but the value collapses. Middle-class savers holding the majority of wealth in savings accounts, money market funds, and treasury securities face the steepest losses. These are the people who followed traditional financial advice. Save diligently, invest conservatively, trust government securities. During transitions, this advice becomes a wealth destruction mechanism, not because it was bad advice during stable periods, but because the rules changed and the advisors didn't update their guidance. Pension funds holding government bonds to match future obligations discover the bonds pay as promised, but the purchasing power is insufficient. Corporate pensions, public employee retirement systems, insurance companies guaranteeing fixed returns all face the same mathematics. The liabilities are fixed, but the assets are denominated in depreciating currency. The gap must be filled by cutting benefits, raising contributions, or admitting insolvency. This is why these transitions destroy middle-class wealth specifically. The wealthy hold diversified assets, including real estate, businesses, international holdings, and commodities. They have access to sophisticated advisors and alternative investments. The poor hold little financial wealth, so there's less to lose. The middle class holds most wealth in the most vulnerable categories: home equity and mortgage property, retirement accounts and bond funds, savings and domestic currency. When the transition accelerates, this concentration becomes fatal. A middle-class family with $200,000 in retirement accounts invested in treasury bonds and $300,000 in home equity can watch their purchasing power decline by 30% or more within a few years, not because the dollar collapses dramatically, but because it loses value steadily against real goods and foreign currencies. Meanwhile, those positioned correctly see different outcomes. Owners of productive businesses with pricing power can raise prices as currency depreciates, protecting margins and cash flow. Farmland owners see land values hold or increase in real terms because food demand doesn't decrease. Gold holders see nominal price increases that offset currency depreciation. The wealth doesn't vanish, it transfers. From Category 1 holders to Category 3 and 4 holders, from those who trusted promises to those who own tangible assets. The transfer is legal, systematic, and largely invisible until it's complete. Here's what makes this particularly dangerous. Most people don't recognize they're exposed until the transition is well underway. They see their grocery bills rising, their rent increasing, their insurance premiums climbing. But they don't connect these symptoms to currency depreciation. They blame corporations for greed, landlords for exploitation, politicians for incompetence, all of which may be partially true, but the underlying mechanism is monetary. By the time recognition occurs, repositioning becomes difficult. Asset prices in categories 3 and 4 have already risen substantially. Gold at $2,600 per ounce is expensive for someone who could have bought it with $200 5 years ago. Farmland at current prices requires significant capital that middle-class savers no longer have after losing purchasing power. This is the trap. The transition happens slowly enough that each individual price increase seems explainable by other factors, but fast enough that by the time the pattern becomes obvious, repositioning is expensive or impossible for most people. The window to act is narrow and closes before the majority realizes it was open. 5 indicators that tell you where we are in this transition and what to watch. Gold to S&P ratio tells you whether capital is prioritizing safety or returns. When gold outperforms stocks, it signals credibility concerns. Track this ratio monthly. Rising ratios mean defensive positioning is accelerating. Farmland price-to-rent ratios reveal whether investors are buying for yield or safety. When prices rise faster than rental income justifies, it signals capital is prioritizing ownership over returns. This is late-stage defensive positioning. Treasury auction foreign participation shows whether international holders still trust dollar-denominated promises. Declining participation below 20% would signal crisis-level loss of confidence. We're currently at 24%, so this requires close monitoring. Commodity-to-bond performance compares real assets to government promises. When commodities outperform bonds consistently, capital is rotating toward tangible assets. This has been true for 4 consecutive years, indicating the transition is well underway. Real estate cap rate compression in productive assets versus financial assets. When agricultural land, industrial facilities, and infrastructure trade at lower yields than trophy properties, it signals discrimination between productive real assets and speculative plays. Watch for this spread widening. This isn't about timing a crash. This isn't about getting rich. This is about not holding worthless promises when the music stops. Next episode, we examine the insurance and pension crisis that nobody's connecting to these currency dynamics, how $900 billion in liabilities becomes unpayable, not through defaults, but through currency depreciation, and why your retirement account might be exposed even if you think it's diversified. The pattern is absolute. The transition is underway. Systems don't break suddenly, they break predictably, then all at once. Understanding what survives isn't speculation. It's recognizing which assets hold value independent of any government's printing press. That pattern has repeated for centuries. It's repeating now. The only variable is whether you see it before the adjustment or after you've paid the price.